Hey, it's Ryan. I thought I could share something interesting with you all today, my fellow student, investor, competitors, and anybody else who comes across this video too. And obviously, this is made for the team as well, and the students, the other ones on the side outside of the team. So, um, I think it would be a good idea to just talk through some macro analysis, macroeconomic events, what's been going on. But today's topic is crude oil. Specifically, you have the two oils. You have WTI, West Texas Intermediate, cheaper one, and the shorter chain hydrocarbon length. Then you have Brent crude oil, which is a little bit more expensive and has a longer chain hydrocarbon length that's not even that useful for the moment, but just for the sake of it, if you ever wonder why the prices are different, it's because of uses, supplies, demands, all of that. Just think of it that way. So, oil. Oil is something that is demanded and supplied. It's a product, right? What's been going on in the markets recently? Well, if you've been paying good attention, close attention, you must have noticed that America has been increasing their production. The US, they've increased shale production because they want to keep oil prices low to stop the risk of inflation, like a high level of inflation occurring. What is the reason of keeping oil prices low? Well, you decrease oil prices, you decrease production costs. And for my fellow econ students here, you get the supply curve shifting to the right because you have a greater incentive to produce. You have less costs, and you're like, you know what, I'm going to produce some more. So in this case, I don't know, a firm that uses or purchases oil to keep heating or whatever, or in its facilities, or I don't know, aid machinery. If it uses oil, fossil fuels, whatever, to heat, or actually get their factories working and sustained and all of that, then the lower price of oil will benefit them. They'll have less costs, they'll have a greater margin, and inevitably that is more profit. But now we need to zoom out and look at it on a macro scale because we know what happens to companies when oil prices are lower. For example, let's look at, I don't know, EasyJet um, and International Airlines Group, two companies uh, in the company list that you're able to trade with in Student Investor. So when oil prices are lower, they are able to then secure fixed amounts of oil. They pay in like futures contracts. So they say, all right, in a few years' time, this is how much we're going to get. And then we're paying you this now based on today's price. So that not all the time, if prices boom, they'll have to pay that price. But also if prices crash, unfortunately, they will have to pay that price. So they bear a hedged risk, we call it. Because they're like, okay, the price could double, but it could easily halve. So we'll say, we'll just pay at today's price to be safe, put it on our accounts, and that's the price we're paying you guys. You can't go back on the agreement. Fair enough. These companies benefit from lower oil prices because fuel's cheaper, and obviously don't benefit. They're negatively impacted by higher oil prices. So now we're going to zoom a little bit out, a little bit more into the macro scale, right? So you're probably wondering what this data is here. This is the US stocks of crude oil, and it excludes something called the SPR. That's called the Strategic Petroleum Reserve. That is like an emergency reserve that the USA holds, and they say, you know what, if markets get too hyped with demand and prices rise so high, we'll just offload a lot of those strategic petroleum reserves, which equate to about 300 odd million barrels. So it's quite similar to the stocks excluding the SPR, but we're just excluding the SPR in this data so that I can understand, are there any trends? Has anything been happening? One thing I can point out from 2017, you had about 500 million barrels, early 2017 or mid 2017, and you can see that production, those stocks in fact, of potential production have been declining as of recent. I think it's weekly we're looking at on this data I've collated, and that production is slowly decreasing. But as of recent, when we had $80 oil prices, it's possible, assuming all other things constant, to just look at this and say, maybe the production's increased, trying to counteract increased demand in the market, maybe. Well, when you have these trade tariffs, you have more tensions, and that means that demand from emerging market economies such as China, who actually are most affected by these tariffs and impositional taxes and stuff, they are actually going to then demand less oil because it's not that profitable when they have more external costs, right? So those external costs could come from a numerous amount of things. In this case, they try to maintain 6.5% GDP growth each year, but there gets to a point where 6.5% of an increasing figure compounded year on year becomes a large figure where it's so difficult to find 6.5% in a nominal value. So say 6.5% of like 60 billion a long time ago. That isn't that difficult, right? For a company that's in a rapidly growing phase of just, I guess we could say it's part of the demographic transition model. I don't know, just a rapidly growing phase, right, of economic growth. Then what happens is you get to a point where you're like, what, a trillion, in the trillions. Now 6.5% of that is a much larger figure than 6.5% of that 60 billion. So it gets more and more difficult to account for that growth. So these nations start saying, all right, we're going to diversify. China went for e-commerce. They went for diversifying in different industries and different countries. In fact, if we were to have a recession today, China wouldn't be so resilient based on their diversification. In fact, they would be quite hurt. And I would almost certainly put it out there that they wouldn't have 6.5% GDP growth. In fact, it's possible that they could even have a negative. Not saying, but I'm saying it's possible because they're now hit from weakness in other nations too. And we mustn't forget that they also hold most of US Treasury bonds. So that's quite an interesting fact to look at. But what has been happening recently? Well, if you analyze the individual data, which I can try and look at here, you had the inventory data come out. This was the crude draw. You had a draw, but recently we've been having a lot of builds. We're in a seasonal period of builds currently. Who knows at the moment where we are off to, but the seasonal period begins from about January, I assume. So it's possible that you can have natural increases in consumer demand because you have draws in distillates, which kind of implies that consumer demand is increasing. So we've been having that recently, so that's nice. It's interesting to analyze now where US ending stocks, obviously excluding the SPR, of crude oil go. I would assume that as the markets, the oil prices have been diving recently, it's possible that producers will want to cut production as it wouldn't be profitable in some areas. And with some methods of production, if you have a high break even, you got break even of $65, now the price is 61, so you could potentially lose if you produce, so you'd stop producing, right? Alright, so I'm going to go on to the next part in a second.